Hello and welcome to the Daily Finance Wrap, your daily dose of personal finance updates covering investments, insurance, loans, real estate, and everything else about your money. We'd love to interact with you and hear more from you. Tell us what you want to talk about, write in with your questions, your queries on this YouTube Live, and we'd love to talk to you. I'm Samina Nalwala, and let's take a look at the top headlines this evening. Reliance Industries has set 28th October 2024 as a record date for the bonus issue of its shares. This was approved at its annual general meeting. The company will issue bonus shares in the ratio of 1:1, which means for every one share held, a shareholder will receive one additional share of Reliance Industries. Shareholders who own RIL shares before the 28th of October 2024 qualify for this bonus issue. The other big story is foreign portfolio investors have been selling out of India. In fact, October recorded the highest number of net sellers or foreign outflows as compared to even March 2020, which was when the COVID pandemic hit. So far in October, FPIs have sold shares with 67,308, making them net sellers on every single trading day in the month of October. With China's resurgence, the thoughts and beliefs are that Chinese markets are witnessing inflows at the cost of Indian equity markets. Well, the pay commission, India raises its dearness by 3% ahead of Diwali. And that's some great news coming for central government employees ahead of Diwali. The Union Cabinet has approved a 3% increase in the dearness allowance for central government employees and dearness relief for pensioners under the 7th Pay Commission on October 16th. With this adjustment, both DA and DR will now be 53% up from the previous 50%. Central government employees will begin receiving the increased dearness allowance in their October salary. This decision will benefit over 1 crore central government employees and pensioners all over the country. Another big news, the CBDT, which is the Central Board of Direct Tax, has issued new guidelines for the Direct Tax Vivad se Viswas Scheme 2024, also known as VSV 2.0. This updated scheme started on the 1st of October 2024, aiming to resolve outstanding income tax disputes. The scheme utilizes 4 key forms. Form 1 for filing declarations and undertakings, Form 2 for issuing certificates by the designated authority, Form 3 for taxpayers to provide payment details, Form 4 for confirming the full and final settlement of tax outstandings. Taxpayers must submit their declarations in Form 1 by December 31st this year. Appeals that are pending before the High Court or Supreme Court as of July 22nd, 2024, will qualify for the scheme. Well, the other big line which has got all our attention is, according to ICRA Analytics, gold ETFs are becoming even more popular now because they offer liquidity, transparency, and align with global prices. This growing interest is reflected in the massive increase in inflows, which jumped nearly 2,700% from 44 crores in September 2019 to 1,232 crores in September 2024. As geopolitical tensions rise, gold has seen a significant outperformance to any other asset class year to date. On back of that, the reputation of being a safe haven asset has caught the attention of investors even more locally. So, well, those are the top headlines that we're tracking this Thursday evening, but it's now down to having a very interesting conversation with a very special guest on the show. As promised, we're going to talk about what is quant investing. We hear that word so often now, especially if you're a newcomer in the markets, you want to know what is this factor-based quant investing, which could help you earn significant returns. Joining me now is a veteran in quant investing, Anish Teli, MD at QED Capital Advisors. Anish, good evening. Thank you for joining us this evening on the show. Anish, I want you to simplify this as much as you can. And I know you've written a book about quant investing, but start by telling our viewers, what is quant investing? And how is this different from traditional mutual fund investing? Anish, can you pause for a second? I think we have an audio difficulty with you. I can't actually hear you, so you want to just try and retest your audio and try and answering the question because I think there's a little bit of a struggle on your audio. We can't hear you at all. But in the meantime, while Anish, of course, gets his audio up and running, let's tell you a little bit about quant investing. In the recent few years, of course, the word quant has caught up with retail investors, ultra HNI investors, largely because of its promise of keeping investments simple and helping you create significant wealth in the long term. Quant investing comes in various ways and forms. It can be used tactically, it can be used strategically, and more importantly, it's as the word suggests, the universe is fairly large. So even simple trades that retail investors or day traders undertake on daily basis by tracking technicals and charts is also a form of quant investing on one end of the spectrum. On the other end of the spectrum, you have PMSs, where fund managers actively use quant, factor, or algo trading, as it's more commonly known, to actually make investment bets. Somewhere in between is passive investing. So funds such as the UTI Momentum, for example, which has had or generated significant returns in the recent past, is another example of quant investing. These funds, of course, have done well, but there are a few risks you want to keep in mind. You want to remember that when the going is good, most investments and most funds do well. But what happens when the tide turns against you? That's what you want to be mindful of. One popular instrument that we hear about, or a product actually that's made it to pretty much most households in India, has been the quant fund. Now, the quant fund, even though the name suggests it's quant investing, is not truly quant and fair to label in that sense, right? So, what you want to keep in mind is there are also strategies out there where fund managers use their discretion to identify stocks that are giving out algo or quant signals, but at the same time, there is intervention coming in from the fund manager. So, very simply put, it's identifying stocks that either have momentum, either picking up value, or of course, just counters that may be the theme in that many ways. So there's a lot that you can do in terms of quant investing. You also have to keep in mind that it's always good to understand this, learn the instrument, and make it work to your advantage. It cannot replace traditional mutual fund investing, but it can complement this in a very beautiful, simplified manner if you understand the instrument to use it. But like we said, I believe we've got Anish back on the show. Anish, I was trying to play the role of the expert, but luckily I have you back. Let's start by telling
I
our
hope you can hear
viewers
me now.
what I can, and I'm so glad I can. Tell
Okay.
our viewers, what is this quant investing? I think Sandeep Tandon's quant fund has made this a very popular
Yeah,
household name. But very few of
correct.
us understand what quant investing is and how is this different from traditional investing.
So, first to explain traditional investing, as we all know, mutual funds that we are all familiar with, a familiar product, is where the fund manager is making an discretionary call based on his analysis, his data, and his view on the market and the stock in general. In quant-based investing, especially factor-based investing, is where we follow a set of rules, or we are taking data into account, and we have a proper process lined up, and that process is followed over a period of time to extract that edge from the market. So it's a repeatable process. It's based in fundamental investing, but it is a rule-based process that is simply put what factor investing is.
Rule based, which sort of makes sense. So, are we saying that unlike a traditional active mutual fund where the fund manager picks stocks on
Yeah.
qualitative aspects, a fund manager running a quant strategy may not just look at qualitative aspects, and you may look at price movement, momentum, category. Or are those the kind of things you would analyze before you add any qualitative contribution in identifying a stock?
Yeah, that's a great question. So, what traditionally what quants or people like me now believe that a lot of the information is there in the price, and a lot more can be learned from the price, as well as a lot can be learned from fundamental data also. In its
Anish, I can't. Anish, I'm struggling to hear you again. Okay, I think we have again a little bit of an audio struggle with Anish. We will try and go back to him to continue this conversation on quant investing. Clearly, the internet isn't supporting us too well. Just let me walk you through what Anish was trying to say. Let's simplify that, right? So, what Anish is trying to indicate that while a traditional fund manager would use only qualitative aspects of identifying a stock, what a quant fund manager does, he also uses data and factor investing, which means, for example, if a company has posted a phenomenal set of numbers, if the price seems attractive, and the counter has not, performed in the recent rally, keeping the price action or price movement in mind, you would have a fund manager use those filters to identify a fundamental stock pick. So, in the true sense of the word, it is still fundamental investing, but with one more layer in terms of adding factor based investing. But the core of it, what you want to remember is that while there are various strategies in which you can build a portfolio, the most important thing to keep in mind is you need to be able to create an asset allocation at a portfolio level. So the idea really is build a core portfolio and then build a satellite portfolio. Your core portfolio can be made up of simple passive strategies such as an ETF or such as a momentum fund. These are low cost strategies that help you make market returns. So, the whole idea of the core portfolio is that you should be able to achieve nifty returns in a low cost manner by, of course, adopting products such as ETF or simple plain vanilla index strategies. In the satellite portfolio, what you have is products and strategies that will help you generate alpha. This could be made up of PMS strategies, which, of course, some may argue is limited to the only wealthy who, of course, can pay that 50 lakh rupee ticket size. But worry not. There are lots of active mutual funds in the broader markets that you could, of course, we will try and connect back to Anish. This is a very interesting topic. So you want to learn more because you truly can, beat the markets, keep your portfolio simple, and of course, protect it from all that volatility. We will step back out and
What's the number of credit cards that you've got?
10 can be a number that we can use. I don't use more than 10-15% of my total.
That's it. Are viewers out there who want to understand the spectrum of expenditure, which is most rewarding?
The highest I've ever got is about 33.3%. And all our flights and hotels were 80% paid by my reward points.
How hardcore do you have to be into knowing all of this?
You could go as deep in it as possible. You'll end up in a rabbit hole and end up spending a lot of time and effort for unproductive returns, honestly.
I want to get to that actually. Let's talk about that.
In 2010, we were the first company to, start this whole thing in India. So for the first 2 years, people thought we were scamming.
Scamming.
If you can't afford the biryani, then eat your dal chawal at home. It's okay.
What a credit card means for the first time borrower.
This is like your old ex.
Okay.
you better
comparison.
you better be graceful even when you end a relationship or you close a credit card. No, credit card गलत है. इसको बिल्कुल use मत करना. लेना भी मत, छूना भी मत.
What are the most effective ways for people to change this behavior?
Back. Sorry to keep you waiting while we've been struggling with audio issues on a day when we're trying to discuss how AI and technology can make life easier. Anish, I hope I have you back.
I think it's still laggy.
I think we need to pray now. But very quickly, let's go back to so you talked about how this is factor-based investing, right? Very quickly, tell me, how is this an additional layer to plain vanilla fundamental investing? So when a fund manager for Quant fund goes out and allocates to funds, he's doing more than just identifying companies based on fundamentals. Is that correct?
Correct. So he's taking into account a lot of qualitative aspects like the quality of the management, the sector, and things like that. But what quants like me believe that a lot of that is available in the price as well, because not everything gets factored in on day one, and in fundamental metrics like price to sales, price to book, price to earnings, which do not get factored into the price on day one. And through a process, one can extract some kind of edge over a period of time and do better than the market and extract a risk premium. So for example, the value factor, which is essentially buying stocks that are not expensive versus buying versus growth stocks, which are buying expensive stocks. So we've seen over a period of time, not just in India but even globally, that value stocks, or the kind that Warren Buffett was known for or Ben Graham was known for, those stocks have done better than growthy expensive stocks over the long run. So I would say the biggest difference is that as a quant investor, you are not a stock picker, and as a fundamental investor, you're trying to pick stocks. As a quant investor, we are trying to build a team, or we are trying to build a portfolio, and we are pretty sure that we will get the best performing or one of the best performing stocks in our portfolio using our process.
Right. So help me understand this. So are you saying with more filters and more layers, a quant fund stands to outperform an active mutual fund in the traditional sense?
Well, I don't know whether not outperform all the time or most of the time, but what you actually get with a quant fund or a factor-based fund, as we would call it, is that 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 process is repeatable. Now, in case of a traditional fund manager, we don't know whether the fund manager got lucky or whether the fund manager was was actually skilled enough to pick those stocks, and it takes years and years of data. But here with factor investing, you have a process-based system which has been tried and tested and is statistically robust. And has been tried across the globe. It works in very, very efficient markets like the US, like Europe, and even in Japan, where most strategies go to die. It has also been shown to work in India over the last 5 years, that we have had factor-based funds like the Momentum Fund, Nifty 200 Momentum 30. We also have the Value 30. And if you see data on that, you'll see that the value factor has done extremely well in the last 4 years post-COVID. Whereas in the decade before that, quality was a factor that was doing extremely well. So factors are not a silver bullet, I don't want to give that impression. But they can have their periods of underperformance. So there is a pain that you may undergo for extracting that premium, and you should not abandon that strategy in a bad time. But there is alpha to be made with these kind of things, and where we think it fits into an investor's portfolio is as a satellite allocation. A core is usually what we say should be built up of index funds, and there you will do better than 90% of the active mutual funds. There's S&P's PIVA report, which viewers and you may be familiar with, which show that 90% of the active mutual fund are not able to beat their own benchmark. So have your core as your have the index fund as your core, and try and add on active mutual funds and factor-based funds as your satellite funds to try and outperform the market and construct the portfolio according to your risks and your goals and all of that.
Right. So your core portfolio, which will be made up of largely index strategies, will give you nifty returns at a low cost. I think that
Correct.
is what's significant to note, and especially in the large cap space where information arbitrage is limited and active, large cap fund managers have found it hard to beat the benchmark. Now, when I look
Right.
at my satellite portfolio, you suggest building that up with active funds. So maybe a Parag Parekh, for example, and adding a few quant strategies. What is the alpha an average investor with enough knowledge to manage his money should be expecting from the satellite portfolio? We'll talk about blended returns in a minute, but the satellite portfolio, where is that alpha generation going to be at?
So if one is able to stick with these funds for at least a 5 year period, a minimum of a 3 year period, you would typically recommend 5 to 7 years. If you're able to stick with that, and that should ideally be your horizon, we've seen in the past that these funds have outperformed the index by almost 3 to 4% over a cycle per annum. So, but like I said, again, they have their cycles, but a 3 to 4% alpha is what you should be expecting out of these factor funds or your active funds that you are adding to your satellite allocation, so that that is in accordance with the risk that you are taking with these instruments.
Assumption that this very intelligent, or at least intelligent sounding quant investing is only for the very wealthy, because you run a PMS minimum tick is 50 lakh rupees. Now everybody doesn't have that kind of money, right? Especially when you're in the wealth creation phase. Do you think there are quant or factor based investing products available for the retail audience on a retail platform?
Yeah, that's the best thing about factor-based funds, right? They can also be packaged for the retail investor who does not have access to, say, high-ticket items like a PMS or an AIF. So there are these factor-based funds by UTI and a lot of other not to take a particular name, but by a lot of other AMCs. So one of the ones that has a long track record now of 4 years is the Nifty 200 Momentum 30. Then we have the Nifty 200 Quality 30, and we also now recently launched a Value 30 fund, that the index that has been launched by NSE, and I'm pretty sure that many AMCs have filed to launch an index fund or an ETF based on that index that NSE has launched. So these many of these they're also available in a multi-factor format. If you want to combine momentum and quality in one factor fund, even that is available, and that
Anish,
is available.
I'm going to quickly interrupt you there. What is momentum and quality? Help us understand this, right? Momentum strategy is where a stock picks up the most active or the biggest gainers in a market.
Yeah, so this flies in the face of modern academic finance theory that past performances does not indicate anything about the future, but there is enough data out there and enough studies out there that show that the stocks that have done well in the past 6 to 12 months go on to do well for the next 3 to 6 months at least. So that in simple terms is what momentum is. Stocks that have done well in the past 6 to 12 months continue to do well in the next 3 to 6 months. That's in simple terms is momentum. Quality is
So
buying
then this
companies that.
momentum strategy is a tactical investment strategy then, because you're only predicting the next 3 to 6 months, right?
Correct. So you would be rebalancing your portfolio. So it is tactical in the sense that you are rebalancing your portfolio every month or every quarter. But what should be long term is your investment in that or belief in that strategy. You should be willing to suffer periods of underperformance for a year, 2 year, 3 years also, because like everything else, equity returns can be lumpy, and all your returns may come in year 4 and 5. So even though you may face a sideways market, you may face a choppy market like we are in the last 3 to 4 months, and in those time
Right.
periods, the momentum may not do well.
Okay. Also, Anish, let's break this down and simplify this further, right? If an investor or one of our viewers has 100 rupees to invest in at the start of every month, how would you recommend he breaks that 100 rupees across passive investing or your core portfolio, like we call it, and across your satellite? And in the satellite, how much would go to active funds, the traditional funds in that sense, and how much would go to a quant strategy of factor investing, such as a UTI momentum case in point?
Right. Again, it's difficult to give a generic answer, but I would say just for the normal average investor, and we make many assumptions here, but let's say 60 to 70% of your investment, I would say, should go first into your index fund. Say about 15 to 20% goes into your active managed fund, and another 20 to 25% is what I would spread across the most robust factors, which are value, momentum, and quality. So I think between 4 and 5 funds, you should be done with your portfolio, and then you can keep evaluating a portfolio on a 6 month, 1 year basis and see that you want to add or rebalance your portfolio at that point in time. But with 4 or 5 funds, you should be more or less covering the gamut of what you can get from these factor funds and active funds.
Anish, what about short-term traders, right? When we spoke, you talked about how day traders also use factor investing in different ways when they look at charts, for example. You want to just elaborate on that a little bit?
Yeah, it's becomes very difficult. So momentum that traditionally we use is we have sometimes we're holding on to stocks for many months, like the PSU rally, which was ferocious in the last 2.5 years. So we were holding on to stocks for almost 24 months. But there are short-term traders or swing traders who try and use some of these strategies on sometimes on an intraday basis, sometimes on a intra-week basis, and see if there is an edge to be made. But here technology also comes into play. You need very fast execution systems, low latency systems, and those technology infrastructure. So that is a very very tough game to follow. I think what the advantage that investors like me or the traditional investor have is that they have time on their side, and that's an edge that they should try and exploit. But some investors do try, but I think as SEBI data has shown, that not many of them end up being very successful in consistent basis. Some of them may end up being successful for a few quarters or a few weeks, but
Right.
consistently doing that is tough.
But if a retail investor, Anish, is willing to put in the time, uh, would you be able to tell them where is a good starting point, right? So while sure, people like you do this for a living, and this is how you create wealth for investors and for yourself in more ways than one. But if a retail investor who wants to take this seriously and create wealth and beat the index and do this intelligently, what should he or she be doing? Where would you go out and learn? What is the basic strategy maybe you can adopt in order to, become or get there eventually? So where is the starting point? Is that even possible?
It's absolutely possible. I think there have been many retail investors many professionals from other fields who have come into investing. There's a process in the US called, which is very famous now, called CanSlim, and that has been used, which is a combination of technicals and fundamentals. That's used as a screening for, and in some sense, it is a multi-factor strategy, because it takes into account earnings, it takes into account relative strength of the stock, and it takes into account relative strength of the market and the industry. And typically, once so there are many books available on this. There are many sites like Zerodha's Varsity, which give a lot of information about this. So that is a great starting point. Bill O'Neill's book called How to Make Money in the Market, that How to Make Money in Stocks, that is a great book to do, to start off with. And a lot of information again is available on YouTube and things like that. But what investors need to understand is that they need to build the discipline, and to build a proper process and system to be able to follow these. And a lot of investors have done this, and still do it in India, and also in the US, where they make their own system. So every system is good. You have to try and pick what suits your personality and what suits your time frame. So many retail investors may not be able to give, or not be able to watch the screen on a continuous basis. So weekly trading systems, or weekly rebalancing, or monthly rebalancing strategies is what I would say that would be ideal for such investors.
Anish, and this is exactly what I wanted to ask. You talked CanSlim model, and I want to give you an example of what, right, or 2 days ago, you had the stock that Beat Street expected. Fair point, Spencer. Bajaj Auto, that's our last few months. As per the CanSlim model, it's at a life high, and the numbers were, the stock should move higher, but it declined 10%. So at this stage, if you're using only Quant, Bajaj Auto and HCL Tech will become buy calls, but both stocks moved in opposite directions. So where does that add up then?
Yeah, so that's a great question, and that's exactly where my quant journey started. Before I was a quant, I was completely on the other side. I was a private equity investor, and when I moved to public markets, one of the things I discovered when I started evaluating my own performance in the public markets is that I did not have a properly defined exit system. So coming back to your question on Bajaj Auto, incidentally, I was looking at that stock today, and I saw that it's reversed exactly from the point where CanSlim would have told you to take your profits. So CanSlim is a system where it tries to tell you to book your profits periodically. You may not capture the big trend, but you will capture 8 to 10% on a regular basis. And today, Bajaj Auto actually reversed exactly from that take profit point suggested by CanSlim. So I think that discipline of there are 99 books on buying, but there is hardly any book on when to sell and when to take profits. And I think uh, that's something that investors need to understand and learn. And you're not going to get 100% of the stocks move. You're not going to capture it. No professional investor is also able to do that. But if you're able, what we try and capture is at least 60 to 70, 80% of the move, if you're lucky. But with a system like CanSlim, I think it
Right?
exactly gives you that. It gives you an exit point, it gives you an exit system and a risk management system, which is what most investors lack.
Show telling our viewers about this CanSlim model of investing, because there's a lot of interest, and I do know a lot of fund managers who actually use this model.
Yeah.
To viewer my next question. Yes.
Yeah. So you were asking me about the CanSlim model, right? If I heard you correct.
Yes, I thought queries from our viewers, and one of them want investing.
Sorry, I missed the last part of that.
I said, are there investing?
Are there forms of
Anish,
other forms of quant
are
investing?
there the quant strategy?
Yeah, I mean, I've written a paper on something called the conservative formula, which is used by Robeco in Europe, and we've tested that on data in India, and that also works pretty well. That's a multi-factor strategy, but is cut and is designed in a different manner. So there are various ways. So I would say that factor investing is basically like a recipe, and every investor will have his or her secret sauce, or I would not say sauce, but maybe a little bit tweak here and there, which makes their process or their system a little bit different from others. But the basic ingredients remain the same. So even in Cancelim, you take into account current earnings, annual earnings, you take into account a catalyst, you take into account whether the sector is strong or not. And that's what you do in a quality stock. You're looking for strong ROE, you're looking for strong operating earnings, and you're looking for whether the company's top line is growing strong or not, and whether it is in a strong sector. Because the Cancelim model believes is that 50% of a stock is driven by the industry, about 25 to 30% is driven by the market, and another 20-25% is because of the stock itself. So if you're able to get your sector right and you're able to get the market direction right, you've probably got 70-75% of the equation in your favor.
Right. Works. You just got to use. With that, and we are completely.
Thanks, Amina. Thanks for having me.